From the morning reading, large professional hedgers in the major equity index futures took advantage of recent volatility to reduce their short positions against stocks to the point of becoming nearly net long for one of the few times since the bull market began, often a good sign. Also, crude oil suffered a 7% decline on Monday, its worst loss since February. On the bright side, the commodity is entering what has typically been a strong time of the year. Over the past 35 years, when crude lost 7% or more on any day in June, July, or August, the next 2 months showed a positive return 7 out of 7 times, averaging plus 30%. Remarkably, its worst loss during the next 2 months averaged only minus 1.6%, while its maximum gain averaged a monstrous plus 49%. Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:36 a.m. Central Time, and I'm recording this in preparation for the market day of July the 7th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in and see just what we've been dealing with in our overnight action. Generally bullish across all 4 of the broad market indices. Were up anywhere from 0.2% to 1/3%, with the NASDAQ being the least bullish and the Russell being the most bullish in relative terms going into the time in which this was cut. In terms of crude oil, it's up almost 1%. Euro down about 2/3%. Bonds up about 0.4%, and gold down about 0.75%. In terms of overseas action, China continues to be pummeled, down over 1%, down 1.27%. Hong Kong down over 1%. Japan up 1.3%. Germany down about 0.5%, and United Kingdom down just a little teeny bit. In terms of macroeconomic reports for today, we have in the U.S. trade balance, and that'll be before the market opens. After the market opens, we have JOLT job openings, and that's it for today. In terms of tomorrow, we have FOMC minutes, so we need to pay attention to that. Obviously, everybody is paying exceptionally close attention to anything coming out of those minutes to get a view for when interest rates might rise. Let's see here. Let's take a look at the volatility report. And you should note that the primary market condition has fallen to a weak bull. This has been strong bull for such a long time. The fact that it finally has broken down to a weak bull, I thought was somewhat interesting. In terms of volatility, the short-term VIX is 16.65, skew less than 125, so no concerns there. Put-call ratio 0.65. IV percentiles 40, 43, 38, 58. So nothing unusual there. These numbers are a little higher than we've seen for most of this year, but certainly in historical context are nothing special. In terms of standard deviation moves, we've not had a standard deviation move in the S&P for a week now, but of course that was a 3 standard deviation move. Obviously, most of the time when you have a really big move, you often get inside days following that. Bottom line is we've not had anything like that kind of activity since that day was put in across all 4 of the broad market indices. In terms of frequency, we're a little low, probably due for another big move. We normally see about 2 a week standard deviation type moves. At least, a 1 standard deviation. That's obviously what happens most of the time. In terms of a regular daily report, we are still phase 5, break of diagonal and horizontal support. In fact, let's go ahead and take a quick look at the charts. On the SPX, notice here, let's dial this in a little bit. We've had 1, 2, 3 taps of this area where we had drawn this fib retracement and the 50% retracement. So that area does seem to be serving as something of a support. And you know, this is one of those hidden support levels. Some people might be saying, well, why is it turning there? When there's not really much in the way of previous horizontal support in the area. But anyhow, it looks like a fib retracement is acting as support there amongst perhaps other variables. We are watching this area right here at the 2039 area very carefully. If this should break the 2057 area on the SPX, we likely will go all the way to 2039. So that could serve to be a pretty good little trading opportunity. So keep an eye on that. Right now, of course, the market appears to be up, and we'll see if we get back up and close into this prior trading range. We had a close here, but then breakdown. This is really quite weak, and we'll have to see what sets up from this. Where does this resolve to? But right now, it does not look very good for the bulls at all. Obviously, very much headline driven of late with Greece. And as situations continue to develop there, we'll see what that does. The Russell put in a nice bullish action yesterday, but you know, we've broken out of this intermediate term bullish channel. You notice how it broke down, came back, tested the backside of that channel, and then broke down again. Yesterday's action, something of a bounce, but notice, you know, you opened way down and then bounced. And then once you close the gap, and then that then failed, and then we had the days closed below the prior day. So while it looks bullish, this is really still not very bullish. It is what we would call a false up day, because we were actually a down day, but it's a green candle. And the fact that we had a false up day that was further rejected, came up to about halfway through this prior candle and then was rejected with a pretty tall wick there, you know, would tell me that while the bulls were in control enough to take this off of that big gap open, it was not enough to be able to have the bulls rule the day by any measure. In terms of NASDAQ, it's very similar to the Russell. Big rejection, big tall wick there at the top. And the Dow probably looks more like the SPX. And notice, you know, we need to get back into this previous trading range. And, you know, this is pretty much an intermediate term bearish trend now. And indeed, you're going to notice something here as we go back to the daily report. While the IBD status is just barely holding on to an uptrend under pressure, many other things are pointing to sell signals. GMI index as an outright sell signal. Stock charts has as PMO signals, you know, red across the board. And in the short term, all sell signals. And in the intermediate term, you have neutral, bullish, neutral, bullish. So an awful lot of breaking down being shown across there. Our intermediate term market posture is now severely bullish. Severely bearish, I should say. S&P down to a 15.8, Dow down to a 13.2, NASDAQ a 17.1. All three of those are severely bullish in their area. The Russell holding on just a little bit better at a very bearish status, still above a 20. Notice the hedge warning status. We've dropped this to a level 3 or crash warning. That isn't a crash guarantee, that is a crash warning. And we refer to a crash as, you know, we're looking for a potential for elevated risk to the point that we could have a full out correction. Correction, of course, being something in the terms of a 10% pullback. Or potentially greater. Now, let me caveat this some more. This is not a prediction that we are going to have a full-out correction. This is an opinion that the risk levels have significantly increased to the point that we are now at level 3, and the potential to be able to break into a full out correction is very, very high. So one of the things you have to always keep in mind is that when we get to these kinds of levels on the risk warning, we often, at that very moment, the bulls muster in control and start to take over. And oftentimes in the past, in this range-bound market that we've experienced in recent weeks, 2-3 days later, we'll often be right back near the top of the range. So just about the time you tickle these elevated risk levels, you see the bulls come in and take you to the top. So that's why I say it's very important to understand that hedge risk level 3 is not a prediction that we are going to break down. And in fact, in range-bound activity, most of the time that doesn't happen. Now, are we still range-bound? It would seem that we broke down from this range and we currently have a close below the prior range. We may not be range-bound anymore, and that certainly is part of what goes into this opinion of hedge risk level 3, combined with other factors, and we'll get to some of those in just a second. But very important that you understand that the risk levels are very much elevated. The potential to break down, if we break through this level here, we're likely drawing all the way down to 2039. If that doesn't hold, we probably have a full out 100% retracement all the way down probably to the 1980 level. So that's you basically have one major line in the sand here, a major line in the sand here that separate the current price action from perhaps as much as 1980. So you could go in a relatively short period of time from 2135 area all the way down to 1980. That is full out hedge risk level 3 kind of risk level. So keep that in mind. In terms of other measures, we have a couple of our warnings actually ebbed off yesterday with the bullish action. We had this volatility cross, and the short-term to intermediate-term status had been in warning stage. Those both actually ebbed off. You also, from a positive standpoint, we had a recent VIX spike, and that's also actually fired a long market signal, so it's looking for a bounce. And of course, we did get a bounce yesterday. The question is, does a bounce continue with a continuation pattern from that very short-term action, or does that just become an opportunity for the bears to reload? VIX on the bearish side has fired long, so that would seem to say that we'll have continued volatility and continued bearish action in the market. Distribution day count remains very high at 7 on the S&P and NASDAQ 5. VIX phase, of course, has been in a climbing phase. Skew has actually not been at a warning status, so that's been something of a positive, or at least a lack of a warning. And then, of course, we have the New York Stock Exchange new high, new low, very, very, very bearish at 804 new monthly lows. Obviously, that is not a good sign. In terms of the risk aversion indicators, we continue to see all 5 of those flagging as risk off. So that is more fuel for the bears. In terms of our special opinions, option income strategies, technically the VIX is inside the acceptable window, so volatility conditions would call it acceptable to initiate new positions. But given the rest of what we're seeing here, especially this hedge level 3, the potential for significantly increasing risk would not, in this opinion, advise to initiate new option income strategies at this point, unless you are a aggressive and experienced trader that knows how to handle those adjustments and are able to make those in a very timely fashion. Cover call strategies. Novice traders should not initiate new positions in this kind of market environment. Aggressive traders should use a one-to-one distribution between in the money and out of the money strikes. Put selling conditions also not acceptable for new core put portfolio positions. For novices, aggressive traders should consider put credit spreads with defined risk and consider scaling into positions until the market has confirmed a bullish posture. That should be enough for today. As always, if you find what we're doing here helpful to your trading, we greatly appreciate you returning the acknowledgement and liking us on YouTube, or if you found us on Twitter, to retweet us to your Twitter followers. And then, of course, stock twits, much the same, whatever your platform of choice. We greatly appreciate the acknowledgement of our efforts and the sharing with your trader community friends. More information can be found at this website about what we do. Disclaimers as always. Hit the pause button to review this in more detail if you need the time. And then, of course, we'll see you back here tomorrow morning before the market opens with the market preview from Falcon Global Traders.